You wake up on a random Tuesday. Nothing dramatic happens. No sirens, no printing presses roaring to life. And yet, somewhere while you were brushing your teeth, millions, maybe billions of new money quietly came into existence. No one announced it. No one voted on it. No ink touched paper. That's the uncomfortable part. We're told money is printed. We imagine machines, governments, stacks of cash. But most money today is born in silence. On screens. Inside balance sheets. Out of thin air but legally. And that matters more right now than almost any other economic idea. Because once you understand how money is actually created, a lot of things stop looking random. Why debt never seems to shrink. Why asset prices feel detached from reality. Why working harder doesn't always mean getting ahead. This isn't a conspiracy story. It's stranger than that. It's normal. Let's start with a small, ordinary moment. You walk into a bank. You ask for a loan. A home loan. A business loan. Even a personal loan. You assume the bank checks a vault somewhere, sees how much money it has, and then decides whether it can lend to you. That's not what happens. The bank does not take someone else's money and hand it to you. It doesn't dip into a pile of savings. It creates new money on the spot. Here's how. When the bank approves your loan, it types a number into your account. That number did not exist the second before. Now it does. Your account balance goes up. The bank's balance sheet grows. And the total money supply increases. No printing. No trucks. Just keystrokes. This is called credit creation. And it's how the majority of money in modern economies is made. Not by governments. By banks. If that sounds exaggerated, consider this. In most countries today, over 90% of money is not cash. It's digital bank money. Numbers in accounts. Promises. So when someone says the government printed too much money, what they usually miss is this. Banks create far more money than central banks ever print. Central banks create base money. Cash. Reserves. The foundation. Commercial banks build skyscrapers on top of it. Now this didn't happen overnight. A few hundred years ago, money was simpler. Gold. Silver. Coins you could drop on a table. Banks were places you stored money. Later, they became places that lent money, but only what they already had. Then someone noticed something dangerous and brilliant. Most people don't withdraw all their money at the same time. So banks started lending more than they physically held, keeping only a fraction as reserves. Fractional reserve banking. That fraction got smaller and smaller, until eventually the system flipped. Banks no longer lend reserves. They create deposits by lending. The reserve comes later if needed. This is the part that sounds fake but is. A loan creates a deposit, not the other way around. When you repay the loan over time, that money is destroyed. Deleted. The opposite of creation. Which means money today is born with debt attached and dies when debt is paid back. Let that sit for a moment. If all debts were paid off tomorrow, most money would disappear. This is why debt is not a side effect of the system. It is the system. Now zoom out. Every mortgage, every car loan, every corporate bond, they are all money creation events. That's why credit booms feel like prosperity. New money floods in. Spending rises. Assets inflate. And that's why credit crunches feel like crises. Money vanishes as loans stop and defaults rise. Nothing magical changed. Just the direction of lending. Here's the quiet irony. Banks are private institutions. But when their bets go wrong, the system suddenly becomes public. Because if too many loans fail at once, money disappears too fast. Economies don't like that. So central banks step in. They lower interest rates. They promise liquidity. They buy assets. Not because they love banks, but because the alternative is collapse. This creates a strange moral tension. Profits are private. Losses are socialized. And over time, everyone learns the lesson. Take more risk. If things go well, you win. If things go badly, the system can't afford to let you fail. This is how bubbles form without anyone feeling irresponsible in the moment. Now let's address the part everyone argues about. Inflation. If money is created so easily, why doesn't everything instantly become expensive? Because money doesn't affect prices evenly. New money enters specific places first. Real estate, stocks, bonds, large corporations. Asset prices rise long before grocery prices do. By the time inflation shows up in daily life, the wealth effect has already happened. Those closest to the money creation benefit first. Those farthest away feel the cost later. This isn't a bug. It's a feature of how credit flows. And it explains why inequality can widen even during growth. More money doesn't mean more value. It means more claims on value. If the real economy, skills, productivity, resources doesn't grow at the same pace, prices eventually adjust. That adjustment is inflation. Now comes the part that makes policymakers nervous. Because once you rely on debt-created money, you need more debt just to keep things stable. Old loans need new loans to be serviced. Growth needs credit expansion. Stagnation feels like danger. So interest rates get pushed lower over time. Cheap money becomes normal. Risk feels manageable. Until it is. Then suddenly rates rise. Debt becomes heavy. And everyone realizes how much of the system depends on confidence continuing forever. This is why markets react so violently to central bank words. Not actions. Words. Because when money is mostly belief encoded as numbers, belief matters. Now none of this means the system is evil. Or fate. We're about to collapse tomorrow. It means it's fragile in specific ways. It means stability requires constant balancing. It means growth comes with trade-offs. And it means money is less solid than we're taught to believe. Which brings us to the present moment. Governments are heavily indebted. Households are stretched. Asset prices are historically high. And trust in institutions is thinner than it looks. At the same time, new forms of money are emerging. Digital currencies, central bank experiments, private alternatives. Some promise freedom. Some promise control. Most promise simplicity. But none escape the core question. Who gets to create money? Under what rules? And who pays the price when those rules fail? Because as long as money can be created without printing, the real constraint isn't paper or ink. It's judgment. And history suggests judgment is not evenly distributed. So the next time you hear that money was printed, remember this. The most powerful money machine doesn't look like a factory. It looks like a spreadsheet. It runs on trust. And it only works as long as everyone agrees not to look too closely at the math. The uncomfortable truth isn't that money is fake. It's that money is a story we keep telling and rewriting in real time. The question is not whether new money will be created tomorrow. It will. The real question is who decides where it goes next.